InterConnect podcast. I'm your host, Lauren, and today I'm joined by someone whose insights are shaping the future of real estate and PropTech, Tom Stults, managing partner at Watchung Capital and other venture capital firms. Tom has a background that bridges private equity, strategic advisory, and cutting-edge tech in the real estate world. He's helping operators and funders position themselves for sustainable growth, capital access, and market advantage. If you are in the prop tech or real estate investment space, this is a conversation you're going to want to lean into. And Tom, welcome to the show. Excited to see you here. That's a pleasure.
Great, thanks
Fantastic.
for having me, Lauren. Excited to be here.
Let's start at the beginning. You have had a really interesting journey from your early days in finance to funding and managing partner of Watchung Capital. Can you walk us through your path and how did you land where you are right now?
Sure, I'll be brief so as not to bore you or others, but it's been a trajectory, I'd say, from a highly institutional, large organization beginning to a much smaller, more entrepreneurial conclusion, or at least stopping point today. So having started my career at Goldman Sachs just about 20 years ago in traditional investment banking and then real estate private equity, and then moving to more of a hedge fund seat for a number of years. For me, that was the foundation to understanding investing, how to think about fundamental investing, and apply that, to real estate specifically, which is the seat that I mostly focus in now. My first foray into more of the innovative, tech-oriented side of the real estate world was in 2015, when I was one of the initial team members at a firm by the name of Cadre, which at the time was a fairly novel platform that had attracted venture capital as a real estate investment platform, but really with a lens towards applying technology to better facilitate capital into real estate. So almost as an investing marketplace, but also to use technology to help underwrite assets and think about how to target certain markets, et cetera. For me, that was exposure to the venture capital ecosystem in the space, alongside a very traditional industry at the time, which is and was real estate. And so it was there for a handful of years, but ultimately had the goal of sort of using that as a springboard to do something adjacent, but again, even more sort of entrepreneurial and independent of that. And so 2019 sort of served up that opportunity for me personally, and decided to form Watchung Capital. And who we are and what we focus on is really a continuation in many respects of that career trajectory. So it continues to be an investing platform focused on real estate, but almost inverting the experience at Cadre, where we don't do all that much new and different as a real estate management platform. We're fairly traditional in terms of how we're set up and structured, but we look to apply innovative operating concepts and models in the investments we make. And so it's really sort of scouring the universe and building on that network of sort of the venture and tech ecosystem within real estate to hopefully do things that are either less competitive or more differentiated than typically our larger and more established peers, in order to ultimately do what most investment managers are trying to do, which is drive outsized returns for us and our investors. And so that's kind of who we are and where we sit today.
Yeah, from a very large institution, Goldman Sachs, to a boutique advisory. But that's your baby anyway. That's why you're here. Was there a turning point that pushed you into launching Watchung? You say Watchung or?
Yeah, Watchung Capital, which is a reference to the I don't call it a hill range, a mountain range. It's more of a hill range near where we live here in New Jersey, but and it means high hills in sort of a traditional Native American term. But there was not a specific turning point. I think there were interesting learnings along the road. And I think a combination of experience and then reading. I'm a big believer that anyone in the investment management space should read, just sort of devour and consume whatever is interesting and relevant that can be read and is published by much smarter people out there. And so for me, it's been a combination of personal experience and sort of consuming others' thoughts and ideas that have helped push me in the direction that I've moved. And one of those really interesting concepts that have come up in a number of different books and conversations over the years is this idea of, do you want to be sort of competing to win, or do you actually want to find areas that are non-competitive? And I've really sort of latched onto this idea of trying to swim away from the competition is, can be obviously risky, but also potentially the most interesting path. And so, I think over time, the experiences at Goldman, after that at Baupost, which is the fund that I was at, and at Cadre, were an interesting set of exposures into what it means to try and compete and win at various levels. And then certain instances where you had the opportunity to be non-competitive and what that meant. And I think there were a couple instances over that time period. I remember investing in mortgage-backed securities in 2008, 2009, which was a totally non-competitive activity. All the banks, all the players have been in that space. And when I look back, that was truly my like shooting fish in a barrel moment of, wow, investing is easy. And it was really easy because it was non-competitive. And I think there are very few pockets of the world and the market, admittedly, where that opportunity exists on a recurring basis. And so I think in moving toward Watchung, part of it was just a personal desire to kind of set something up and make something happen. But it was always also looking around the corner to, what are existing real estate players not willing or able to do for whatever reason. And it might be because of their size. It might be because of their, inability to underwrite certain things or connect with certain parts of the market that they hadn't done traditionally. And that's really sort of for us been the driving force behind, first getting set up as a business and then thinking about what we are willing or not willing to do and how we might, quote unquote, outcompete against obviously much larger, more established
That's awesome.
firms.
And for folks who may not be familiar, what is Watchung Capital all about, and what kind of clients or partners do you typically work with?
Yeah, I mean, like our simple goal is to deliver, returns that mimic the downside protection, tax advantages, et cetera, of real estate. So, I'd say in that sense, a sort of more income downside oriented product, but where we can identify, the upside associated with applying technology, new concepts, et cetera, in a way that deliver interesting and outsized returns. So that's what we are in a nutshell. We do that on behalf of primarily a range of investors from individual high net worths through family offices to larger institutions that we partner with. We are not structured as a single fund vehicle. Rather, we have a series of individual asset partnerships and or joint ventures where we sort of thematically invest behind a very specific set of ideas or opportunities.
What do you think sets Watchung apart in a very crowded space like investment advisory or PropTech?
Yeah, I mean, and I'm not saying it's necessarily led to us doing better in any specific regard than anyone else. But I think the thing that really set us apart, especially when we set up the business in 2019, was an idea that's now fairly commonplace, which is this concept of sort of opco, propco within real estate, where, early days of real estate venture funding, some of the big names that stand out are the likes of WeWork, et cetera, that had the ability to raise tons of money from the likes of SoftBank to both invest in technology, but also invest in real estate and operating businesses that realistically, in retrospect, shouldn't necessarily be funded by venture dollars. But, the venture market was there, the funding was there. And so firms like WeWork as the poster child, but many others at just different orders of magnitude, basically went out and raised a bunch of money to kind of do everything under one umbrella. The results there have been almost uniformly disappointing, if not outright terrible. And so we were, I think, one of the first, I'd like to believe, that kind of came along and explicitly took a view that the venture market should not be funding real estate opportunities. The venture market should be funding tech businesses, software, business profiles, very high growth, sort of exponentially scalable opportunities. In most respects, real estate is linear in terms of how you grow, and it takes time. Deals take time, et cetera. And so those two things don't marry well necessarily. And so I think we took the view that there's a really interesting opportunity coming from the real estate side to basically be a partner to interesting concepts and ideas that may merit venture funding if they focused on retaining their asset light approach. And so, a lot of our early investments and ongoing focus has been identifying, again, really high quality ideas and opportunities, some of which are venture capital backed, some are not, and figuring out a way to be their real estate partner of choice. And so to give a simple example, I'll give one on the residential side and then one on the sort of commercial industrial side. One of our first deals was basically buying a multifamily property and installing a short-term rental operator for a portion of the property. And I think we went about it in a really thoughtful way that, again, sort of back to that idea of trying to be anti-competitive. I think we had the capacity to go out and evaluate all the short-term rental operators in the space at the time, and there were many, and figure out which one was approaching this business the right way from an operational standpoint as well as a capitalization standpoint, because we wanted a management partner who would exist long-term. And we found that in a company by the name of Casa, who were basically signing on only management contracts and not leases. And we agreed to structure a management contract for them to run a portion of our building as a short-term rental operation. COVID hit immediately after we closed our first deal. And so the tide went out for everyone very quickly. And I'd like to think that, even though it was painful for us, what we didn't have was a partner that had a bunch of lease liabilities, which many of Casa's peers did. And basically were instantly wiped out, many of their peers. And so we had a partner that was well-structured. And we were basically able to coexist alongside them through the dark days of COVID and come out the other end. And I'd like to think that, our work up front evaluating that space differentiated our ability to pick one of the few winners in the short-term rental space and sort of come out the other end and thrive at that property. And so that was, it's a unique advantage or sort of approach for us. And we've done similar on the industrial side, where we basically evaluated a small number of operators. This was back in 2019, 2020, who were looking to basically unlock very small, flexible space for small, medium-sized businesses to operate within industrial, where typically you need to be leasing at least 10,000 to 20,000 square feet to get broker and landlords' attentions. And our goal was to take larger spaces, basically chop them up with modular walls, install an operating partner to help bring in dozens of small, medium-sized, primarily e-commerce businesses. And we picked a partner to do that, similarly figured out a way to structure that deal, and had significant success across a number of transactions in doing that. And so I think for us, again, relative to sort of traditional multifamily or traditional industrial investors, it gave us admittedly, the conviction to just invest in that space to begin with, thinking that we had a differentiated view. And in both instances, allowed us to achieve a cash flow profile that we believe were better than would have been achieved, absent installing those partners. And so I think those are good examples for us of kind of what it means, from our lens to sort of, find a place to sort of compete and win within, what is otherwise a very obviously competitive and crowded space.
That's very interesting, and thank you very much for the example. Gives a big, great insights. Let's talk about trends or about the broader landscape. And there's a lot of happening at the intersection of capital and technology in real estate. And from your vantage point, what are some of the biggest trends or shifts you're watching closely?
Yeah, I mean, again, I'm not a pure venture investor, but we work closely with a number of groups. Most specifically, a group I know of Zig Capital, which is a very reputable sort of venture investing firm that focuses on the PropTech space. And I think I'm going to echo what I see from them and many others, which is, look, it was a much easier time to be an entrepreneur starting a venture backed business 3, 5, 7 years ago. So the trend that we see currently is that the market is very tight for anyone looking for early stage dollars to launch a concept, especially in this sort of real estate adjacent construction tech, prop tech world. And I think that's a function of obviously the broader capital markets today, interest rates being higher, required returns being higher, but also just the reality of what the experience has been for those venture investors over the past several years, which again has been a lot of bad outcomes for businesses that necessarily should not have necessarily been venture capital backed businesses to begin with. And so I'd say we see that trend having reached almost its logical conclusion at this point, where the bar is so much higher for new ideas within real estate to get funded through venture dollars. And we believe that that's not a bad thing. We believe that that's a necessary correction from what was an overabundance of capital funding, not fully baked, not well conceived ideas, especially within our space over the last several years. And so we see fewer and fewer well qualified, well capitalized opportunities or groups that are bringing new operating concepts, ideas, and technologies into the real estate space. The best ones will still make it and are still sort of getting through that noise, but it's a much higher bar to get things done initially. So that's definitely a trend that we see and we don't believe is going to reverse anytime soon. The second piece that goes alongside that I think is interesting for us is that does actually open the door in many ways for real estate investors and operators like ourselves to have a more exciting opportunity set, frankly. Which is to say that, 5 years ago, a typical conversation we might have seen was a group had an interesting hospitality concept and sort of technology platform that they were building. They come to us after they've already raised $5 million in seed funding at a $30 million valuation, and now they're looking for a real estate partner to implement their idea with. That to us is a bad dynamic because there's no opportunity to necessarily align ourselves with them at the ground floor. They've already achieved a valuation that's well in excess of whatever we could have imagined as a real estate investor looking at their business as a sort of traditional management or operating company. And so there's sort of misalignment from day one. And I think where the market has moved and is continuing to move is something very different, where groups with an idea like this are having to go about the old-fashioned way, which is find a real estate partner, landlord, capital source, et cetera, like ourselves, and effectively pressure test their idea day one before they raise any money. And if there's merit to their idea, ideally for someone like us, that opens the door to be a participant both at the real estate side as well as in that operating platform as we sort of help it grow collectively. And so again, I think the removal of what I would call the easy venture money from the system has created an opportunity for groups like us and others that are looking to partner with interesting concepts and ideas to frankly get more exposure to those platforms if they are successful, have better negotiating leverage in terms of what those deals are going to look like, et cetera. I would say beyond that, look, this is a point in time comment, but it's a highly volatile market right now. And so by definition, when things are volatile, people tend to retreat. People retreat to more traditional asset classes. Financing retreats to things that it's most comfortable financing. And so the ability to push the envelope in terms of capitalizing and bringing investors into new ideas is more limited. And so, when things get volatile and uncertain, sort of that march of progress within our industry and others does admittedly slow down a little bit. You're just going to see less new and interesting ideas financed. Again, that's not always a bad thing, but it's just the reality we're facing today. And we see it too, which is like we are less willing to go out on a limb and really try something totally novel today than we might have been even a few years ago. But at the same time, it also means when we do find something we're excited about, there tends to be less competition around it.
That's very interesting. Yeah, no, definitely the time is crazy and it's going to be crazy for a while, I think. And obviously, money and the market don't like it, and we'll see. I mean, we'll see what happens. We'll see what happens. But how
I was just going to say it's one of those times where everyone wishes they had a crystal ball.
Of course.
And the one guy who does, I don't think he knows exactly where he wants to go with this either. So I think we're all kind of following someone's lead and not sure where that's going to go. And again, I think within just to apply it to the real estate industry, there are competing forces. On the one hand, I think some people are looking through this and seeing a silver lining of, maybe all this uncertainty actually brings down, interest rates and financing costs. And that's, I think, the most optimistic view that people within real estate are taking, which is, this is going to be an economic downturn, and therefore financing costs are going to drop, and we can refinance stuff more cheaply, finance more aggressively. In the interim, obviously, we tend to not be in the development business, but it's a very scary time to be a developer where you have costs that you're trying to project, stuff that you're trying to do. We do have a platform that we set up that makes loans to the residential home building market, and that's one too where the U.S. needs more homes. Everyone agrees with that, and yet at the same time, the current dynamic makes it even more uncertain and difficult to think about how do we deliver those homes in a cost-effective way, right? When your input costs are rising or uncertain, et cetera. So yeah, it's all that to say, it's a really tricky time to think about. Putting politics aside, I think anyone would tell you it's very difficult to underwrite volatility and uncertainty, and so the immediate impact of that is people just tend to sit on the sidelines a little bit if they can.
No. I mean, hopefully you find opportunities going forward, but obviously you will. How are traditional investment model adapting to the rise of PropTech, in your opinion?
Look, in my opinion, it's a common refrain for the tech industry to claim that real estate is very slow to adopt technology. That real estate owners and landlords are very old fashioned. They're allergic to new ideas, et cetera. Maybe I'm taking the side of the real estate industry because I'm in it, but I have a very different perspective. I think that a lot of those comments stem from a little bit of a misunderstanding or lack of depth of knowledge around what really drives the real estate industry, and how does tech either apply to that or not. Real estate is one of the most what I'd call numerically efficient and commercial industries. It's really driven by knowable bottom lines, right? Landlords across the world are generally trying to solve first and foremost to how do I maximize the value and cash flow of my assets. That is the business they're in. And obviously some take a shorter or longer term view to that by thinking about, if I invest in experience or, ESG, green buildings, et cetera, it's going to ultimately inure to my benefit long term. Others are much more short term, just thinking, how do I invest as little as possible to maximize cash flow? So there are different approaches to it, but at the end of the day, they're all trying to achieve the same thing, which is kind of maximum value of their assets. And that's the business that they're in. I think a lot of, the players on the tech side that have tried to crack sort of the real estate world as their customer effectively, whether it's, landlords, operators, et cetera, sometimes are just sort of willingly or not willingly ignorant of that basic idea. And so a lot of the proposed solutions for the real estate market are either, they really fall into two buckets, the ones that don't get any traction. They're solutions in search of a problem. So they're addressing an issue that just fundamentally doesn't really exist in the space. And again, that's just a lack of understanding issue. Or they are solutions that have a high implementation cost and a high sort of what I call like operational personnel time expense to them, but that just have a really immaterial impact on the bottom line, basis points at best. And so it looks like something that, for example, a landlord should use in terms of property management modules, things like that, but it just really doesn't move the bottom line. So the incentive for someone to invest the time and money and energy to adopt a lot of these technologies is very low when the output or the input or the actual impact on their bottom line is negligible. And so, I think that it's a common gripe, again, from the tech side that, landlords are slow to adopt. My view is no, landlords are actually just very discerning, very deliberate, and very economic animals when it comes to thinking about what tech makes sense in real estate. And so over time, more and better technology is being built. New ideas always arise. And so that curve of adoption within real estate will continue to improve. But again, it's slow and it's gradual, and the bar is very high for truly impactful ideas to make a difference. And like so many other industries, it's the stuff that almost creates its own new niche within real estate that can have the biggest impact. So when you look at like what has really been a winner within the prop tech space, I point to groups like Airbnb, right? And Airbnb was this totally new and different concept. They weren't selling some small software improvement to an office landlord, right? They were coming up with a fundamentally new way of effectively unlocking supply and demand within the real estate marketplace. I'm not a good around the corner thinker to tell you what might be next in that regard. That's just my view around what has actually created the most exciting businesses and the most value in this space are things that come at it from a totally different lens rather than trying to effectively sell into the existing real estate marketplace.
No, that makes sense. Yeah, Airbnb is a phenomenon, definitely, and still going. Let's get into the pain points because we both know that real estate world isn't all smooth sailing. And from your conversation and your own experience, what are some of the biggest challenges that funders or operators in PropTech are facing right now?
Some of the biggest challenges are just, where are you in your business, on the sort of priority totem pole relative to all the other challenges this industry is facing right now, right? It can be really tough when, even if you have actually created something that seems to deliver value to the space, that's a new way of doing things, or is fundamentally, driving bottom line for players within the real estate market. It can be really hard to gain traction when the world is on fire and a landlord's financing costs have gone up 2-3x from where they were 3 years ago. When input costs for renovations or development are being adjusted by 20-30% because of tariffs. It's kind of like a lot of these people who are trying to make inroads and innovate within this space, back to the comments I made earlier, you're just getting deprioritized right now because it's not a smooth sailing environment. It is, I've referred to the last few years within real estate, while the overall markets have been sort of, generally speaking, on the upward. Real estate has felt like commercial real estate specifically has felt like it's been in its own kind of mini depression over the last few years. And I think most people in this space would tell you it's been the hardest market to invest in, sell out of, raise money around since at least 2008, 2009. And so that is a very challenging market for incumbents, let alone new entrants trying to innovate and sell into that space. So again, I keep going back to like the market environment, but real estate is a very capital markets sensitive industry. And when capital markets are a headwind, I think it's very hard for new concepts to effectively, get the attention that they want and deserve in many respects.
Yeah, no, that's right. Have you noticed a shift in what LPs or investors are expecting in the current cycle?
Yeah. Again, I'll speak to the venture side, even though I'm not really a venture guy myself.
Sorry.
There, it's all about sort of business model and market. It's going back to sort of the traditional what is venture actually like. We like software, we like SaaS businesses, we like high margin, asset light, opportunities. And so that's what investors and LPs are looking for when it comes to anything that is in the real estate space that is not hard asset investing. On the hard asset side, it's a trickier question, and it's something we wrestle with on a daily basis as we think about what deals are exciting to us and what deals are exciting to our capital partners. I would say that, again, novelty is not something that people are looking for today. It's about risk mitigation first and foremost. I've said repeatedly over the last couple of years, it's a better time to be a lender than a borrower in the current environment where financing costs have risen. And in order for investing as a borrower to be exciting, that means asset costs, generally speaking, have to go down to make your returns more exciting as a buyer. We haven't seen that in a pronounced enough fashion to sit here today and say that equity investing is as exciting as it was 5 years ago. It's just not. And so, if I had to sort of give a succinct answer on the real estate side, I would say, look, I like the risk return of being a lender today relative to being a borrower. And as I mentioned, we have a lending platform, and that's where we spend a lot of our time and are really sort of investing most of our capital today is on the lending side, where we think we can earn returns that look like equity returns almost, given where rates are and given where the lack of competition from banks, et cetera, is. And it's a very clear bar for us when we think about if we're going to be a borrower, which is a higher risk position, we have to at least exceed the returns we're getting as a lender. And it's surprising how few opportunities today present themselves where that is the case.
Thank you for your answers. Looking ahead, what's your vision? You mentioned it a little bit. What's your vision for Watchung the next few years, and what kind of impact do you want to have on the ecosystem?
Yeah, I mean, it's hard to give you a concrete vision. I think we're very sort of opportunistic and responsive. So it's not a situation where I sit here and think, okay, we want to have 3 times our assets under management, et cetera. We'll see where the wind in the markets and the opportunities take us. But I will say, our goal for impact has always been one where the most exciting investments for us are the ones where we sort of find a new, what I would call, product market fit at the asset level, where we think that we deliver a property or an opportunity that does well for us because we've attracted demand to that property in a way that didn't necessarily exist before. And so, if I give the 2 examples that I referenced earlier, it's if you create a really nice residential property that has all the traditional good amenities for long-term tenants, but you also thoughtfully convert part of it to short-term stays, you're unlocking a better than hotel product for families, et cetera, that want to use that space. And, beyond the numbers, that's something we like doing. It's a good feeling when you sort of deliver something to a market that, quote unquote, needed it. And the way that that is because you see that demand flow through your income statement on a weekly, monthly basis. And that's a reflection of the fact that you've delivered a desirable, asset into that market. I'd say the same holds true for our industrial product, which is, it's very rewarding when you see a bunch of small, medium-sized businesses, filling your space and providing very positive feedback around them finding something that didn't heretofore exist. And so that remains sort of a driving motivation for us, which is thinking about real estate in the context of really any consumer product, which is let's deliver something that the market wants and needs at the asset level, and let that be sort of our guide, and let that be a measure of success when we actually do that.
Very nice. Fair enough. If you could fast forward 2-3 years, and what's one shift in the PropTech and capital market space you hope we have nailed as an industry?
Look, I would like to think, fast forwarding, 2-3 years, that there are a number of, I'd like to think honestly that there's a lot of room to innovate around the financing side for the real estate market. As I mentioned, it's a top of mind issue for the real estate industry. How do I finance my assets more efficiently? We're in a world where banks have continued to retreat over the years. There are fewer and fewer regional banks, local banks. That's a lifeblood of so much of the real estate market. And you have the big money center banks who are they're large. In many cases, they're great, but they're not well set up to sort of effectively service the entire real estate market. That opens up a wide range of holes that new entrants can come into. Some of those can be sort of traditional non-bank lenders, but I think there's a lot of opportunity there for the more sort of tech-driven, innovative side of the ecosystem to sort of step in and think about how do we more efficiently capitalize this space. When we think about actual needle movers, like that is a huge needle mover for the real estate space generally. And there are a number of firms that I've seen that are doing that and thinking about approaches to do that, but I think there's room for more. And I'm hopeful that what we're going to see less of are less kind of nice to have, sort of simple, modest improvements around sort of property management, operations management, et cetera. I think I view those as kind of like table stakes tech bells and whistles that I just see a dime a dozen too many of, over the past several years. So hopefully fewer of those things and more of these kind of like big picture capital structure solution ideas. And I think the part that's going to be really interesting, and again, you asked sort of what do I hope is solved for? This is more a question of where do I think that people might need to sort of turn and pay attention. Like there are like whole asset class shifts going on right now. So like data centers as an asset class is just exploding into this sort of like it's going to have sub asset classes and it's just the demand there and there'll be booms and busts along the way for sure. But whenever there's just such a fundamental shift in terms of space needs for the US or for the world, there's a lot to think about and do there. And I think groups that are really, and that's where tech, and sort of venture-backed businesses that should be at the forefront is just thinking around the corner faster than traditional real estate incumbents to think about how can we get involved and play and sort of supercharge, the need to sort of address whether it is data, power demand, et cetera, in the space. I think that is less true for industries that are fundamentally challenged. If I were giving counsel to someone thinking about starting a business in venture today, I wouldn't say try and figure out a way to better utilize office space. That wouldn't be my suggestion, right? It would be, go get super smart on data centers, go get super smart on, power generation needs within that space and figure out some way to help the real estate industry address that. Rather than solving sort of antiquated or sort of like, sort of surplus space use issues. So it'll be really interesting kind of, how the data center space especially evolves over the next few years. Again, it's one that we've been bystanders. We are not active in that space, but in terms of what is the most dynamic part of the market, that's unequivocally it.
That's very interesting. That's a great insight, definitely. One thing we are trying to do with this podcast is spotlight real voices in multiple languages and across borders. How important do you think it is for PropTech and capital market leaders to build visibility internationally? And what role does thought leadership play in that?
It's interesting because real estate can be a very siloed industry just because it's physical in nature, right? And so you can exist and be very successywhere
over here, but not over
career, here. Just within your borders, especially the US because it's such a huge market. But anywhere, France, UK, et cetera, you can just exist, keep your blinders on, and sort of conduct your business and be very successful within your own delineated market. I would say the importance of picking our heads up and sort of having a conversation or at least an understanding of what's going on across those markets is the same as any other industry, which is, it's very often the case that someone's tried something before in another market before you thought of it or tried it in your market. And so getting smart on what worked for them or what didn't work for them, how that applies to your market and what might or could be done differently, right? Inevitably, hopefully saves you a lot of pain. And also if you're really picking your heads up for a lot of markets, something's been done in another market. It hasn't yet been applied to your market. And so it's also an opportunity, right? It's an opportunity to find ideas. It's an opportunity back to sort of our founding thesis of how do you be sort of non-competitive in what you do. Well, one way to do that is look across markets, understand what's happening elsewhere. And thankfully, when it's happening elsewhere, it's not happening where you are. And so it's not competitive with you. You can learn a lot from it and apply it, to your own business, your own market. So I think I will admit, within the U.S., it's especially easy to just ignore the rest of the world, given the size of your market. Many people exist solely in New York, for example, and don't even focus on the rest of the country, let
That's true.
alone the world. So I think and our day jobs keep us busy doing just that. But I do think there is a lot to be learned when you can pick up your head, understand what's working or not working in other markets. Are there parallels to our market? And is there something I can do with that here?
Yeah, very right. And I hope we can help in that nature. Um, uh, Great. All right. So before we wrap up, some quick, fun, rapid questions. What's your daily habit or tool that keeps you sharp?
I'm a runner, so wake up early and go on a run. And it's that
Fantastic.
moment for me where sometimes I think about nothing. Sometimes I have a thought that I chew over and over, 30 times over the course of it. But it's a good way to sort of refresh and reset, and that keeps me sharp every day.
That's wonderful. Is there a book, a podcast, a mentor that really shape your thinking?
Uh, I'm I'm not the type that reads a book over and over and over. I'm more of sort of I'll read as many different books as I can. So I often reference whatever the most recent thing that I'm reading as being sort of the thing that's particularly influential for me. So no, I won't name one book. I'm actually just by being on a podcast. I'm not a huge podcast guy either. I'm sorry to say.
Don't worry.
I do listen to
Of
a
course.
few, but no, in a more sort of old fashioned sense, I try to really read as much as I can of the New York Times, the FT, the Wall Street Journal every day. I just think that exercise, The Economist, that exercise of just sort of staying current with the world and connecting the dots around what's going on. Again, sort of back to your point, what sort of keeps you sharp, what keeps you thinking. It just helps me feel like I've got my finger on the pulse of obviously the broader world, but then thinking about, okay, how does this apply to what I'm doing on a daily basis? Should I be doing something differently? Is there something I shouldn't be thinking about? Is what I'm doing important in the scheme of everything I'm reading about?
Yeah.
It just raises good sort of existential questions on a daily basis. So I think just being a good consumer of news, hopefully real news and not fake news,
No,
is
of course.
is an important part of being an engaged professional.
Okay. Okay. If you had to bet on a underrated prop tech company or trend, what would it be?
Uh, um, you know, I think a lot of people have sort of thrown out the idea that there can be great companies built within the hospitality space. So there was a flurry of activity there early on in prop tech, and I'm not talking about Airbnb. I'm talking about groups that run hotels differently. Are the back end for hospitality, et cetera. Um, you know, I continue to believe that is one of the most dynamic parts of the real estate market, just because you are catering to customers on a daily basis. And so I think that allows some of the greatest opportunity for sort of innovation within real estate, just because it really is about customer experience almost more than any other part of the real estate market. And so I think we haven't seen too many businesses emerge that are like true winners within sort of the hospitality tech ecosystem, but I'd like to think over time that's going to become a more and more tech enabled market. And look, it may be one where the incumbents do it and make it happen. But if I had to sort of look across the real estate ecosystem, I think you're more likely to see interesting businesses emerge related to hospitality than, for example, you are multifamily, industrial, office, et cetera.
Awesome. Um, Tom, that was great. That was awesome. I appreciate you sharing your journey and insight with us. It's conversation like that that help other funders and operators navigate the real world challenges we are facing. And if people want to connect with you or learn more about Watchung Capital or just follow your thinking, what's the best way to reach you?
Yeah. As with most people, you can find me on LinkedIn or shoot me an email at at watchungcap.com. Yeah, happy to hear from you. Always happy to be helpful if possible. But Laurent, thank you for your time and the good questions. And yeah, hopefully there were some kernels in there that are helpful to those who are listening. So I do appreciate it.
That's wonderful. Thanks again, Tom. Looking forward to getting this episode out and translated in Spanish and French, so more folks can benefit from what you shared. And thank you very much. Have a fantastic day. We keep in touch.
Thank you.
Thank you.
All right,
Thank you,
take care.
brother.
Bye.
Ciao. Hold on.